It's happening again. 3 times in the last 100 years, a very specific pattern showed up in the market. And every single time, the people who recognized it and acted on it, regular people with regular jobs, ended up building generational wealth. The pattern is showing up again right now, in 2026. And most people have no idea. I'm going to show you exactly what happened in 1932, in 1974, and in 2009. 3 very different eras. 3 very different problems. But the same setup underneath every single one. And then I'm going to show you what's happening in the market right now, using real current data, and let you decide what it means for you. This is not a prediction. I'm not here to tell you what the market is going to do tomorrow. What I'm going to do is walk you through more than 90 years of documented market history, and then hold it up next to what's happening in 2026. Because the pattern is clear, and the people who see it early are the ones who benefit most. So make sure to stay until the end to have a step-by-step strategy. Leave a like, and let's go back to July 8th, 1932. If you were alive that day, you had already watched the market lose 89% of its value from its 1929 peak. Not 10%, not 20%, 89%. The Dow Jones, which had hit 381 points in September 1929, was now sitting at 41.22. It had been falling, almost without stopping, for nearly 3 years straight. Think about what that means for a second. If you had $10,000 in the stock market in September 1929, by July 1932, you had $1,100 left. Your money had basically been destroyed. Unemployment was at 24%. 1 in 4 Americans had no job. Nearly 3,000 banks had failed in just 1931 alone. People were living in shacks on the edges of cities. They called those neighborhoods Hoovervilles, after the president who kept telling everyone things would get better. Nobody trusted the market. Nobody trusted the banks. The word on every street corner was that capitalism itself was broken. Newspapers were saying the economy might never come back. Economists, serious ones, were questioning whether the stock market had any future at all. And yet, a handful of people did something that looked absolutely insane at the time. They bought stocks. Not because they had some magical information. Not because they were geniuses. But because they understood one thing that almost nobody else could see in that moment of panic. The price of assets had fallen so far below their real value that math itself was on their side. Here's what happened next. From that low in July 1932, the Dow went on to gain over 90% in the following 12 months. People who bought at the bottom and held through the 1930s recovery and into the post-war boom made fortunes that lasted generations. The companies hadn't disappeared. America hadn't disappeared. The world just had to get through the fear first. Now let's jump to 1973 and 1974. The context this time was different, but the feeling was the same. Oil prices had quadrupled almost overnight after the Arab oil embargo hit. Inflation was running at over 12% per year. President Nixon had just resigned. The Bretton Woods monetary system, which had governed global finance since World War II, had completely collapsed. The US economy officially entered a recession. By December 6, 1974, the Dow Jones had dropped to 577 points. That was a 43% decline in less than 2 years. The S&P 500 had fallen nearly 50% from its peak. Every day the market just kept going down. One fund manager at the time described it like this. It was like a mudslide. Every day you came in, watched the market go down another percent, and went home. The average new home cost $34,900 that year, and people still couldn't afford them because prices for everything were going up, while their investments were collapsing. Again, the mood was apocalyptic. But what happened after that December 1974 bottom? The market started recovering almost immediately. By 1975, the Dow was up 38% in a single year. By the end of the decade, those who had bought at the lows had more than doubled their money. And then came the 1980s bull market, one of the longest in history, which turned those same positions into something extraordinary. Now 2009, most of you probably remember this one. The global financial crisis had just wiped out trillions in wealth. Lehman Brothers had collapsed. Bear Stearns was gone. Washington Mutual, the 6th largest bank in the United States, had failed overnight. Housing prices had fallen 30% in major cities. Unemployment was climbing toward 10%. On March 9, 2009, the S&P 500 hit its lowest point of the crisis, 676. It had fallen 57% from its October 2007 peak. The news was calling it a second Great Depression. Banks were on life support. The auto industry was being bailed out. People were losing their homes. Their retirement accounts looked like they'd been cut in half. What did the people who bought at that March 2009 low end up with? If you put $10,000 into the S&P 500 on March 9th, 2009, that money grew to over $80,000 by 2024. That's an 800% return, not from guessing, not from luck, just from seeing that the fear in the market had pushed prices far below reality and acting on it. Apple was trading around $12 per share in early 2009. Amazon was at $85. Companies that were still selling products, still generating revenue, still employing thousands of people, but priced like they were about to disappear. Just a reminder, if you want to build a business and don't know where to start, remember that YouTube is on easy mode now, and it's blowing up every small channel that does things right, as I teach you in my free community in the link below. So what do 1932, 1974, and 2009 all have in common? Every single time, the setup was identical. A major external shock, a depression, a war and energy crisis, a financial collapse, massive fear in the market, headlines predicting permanent damage, assets priced at levels that made no mathematical sense compared to the underlying businesses, and the people who recognized that prices had disconnected from reality and bought while everyone else was selling. They became the wealth stories that people talk about decades later. Here's the part that most people miss. You don't get the opportunity to buy at those moments by accident. You have to be watching, you have to understand the pattern, and you have to have the psychological framework to act when your gut is screaming at you not to. Let's talk about the psychology first, because this is everything. In every single one of those three moments, 1932, 1974, and 2009, the people who didn't act didn't fail because they lacked information. They failed because of how human brains are wired. We are built to avoid danger. When markets crash, when the news is terrible, when everyone around us is panicking, our brain treats that as a life-threatening situation. It tells us to run, to sell, to get to safety. And that instinct is exactly backwards when it comes to investing. The people who built wealth during those crashes weren't necessarily smarter. They weren't richer. They just had a framework that allowed them to override that panic response. They understood that market cycles are real and documented, that every major crash in the last 150 years has eventually recovered and moved to new highs, that the greatest risk in investing isn't buying during a crash, it's missing the recovery. Now let's talk about the data behind that recovery pattern, because this part is important. Going back through over 150 years of US market history, every bear market of 20% or more has eventually been followed by a full recovery and new highs. Every single one, including the Great Depression, including 1974, including 2008. The average bear market lasts about 14 months. The average recovery from the bottom to new highs takes about 2 to 3 years. And the average return in the 3 years following a bear market bottom is over 100%. Let that sink in. If you bought at the exact wrong time, right before a crash, you would still have made money if you held long enough. And if you bought at or near a bottom, the returns were extraordinary. But here's where most people completely blow it. They wait for confirmation. They want to see the market go up before they buy. They want to feel safe. And by the time they feel safe, the biggest gains are already gone. In 2009, the S&P 500 gained 68% in the first 12 months after the March bottom. If you waited until the news was positive, until things felt okay, until your friends were talking about stocks again, you had already missed most of that move. The same thing happened after 1974, after 1932, after every major crash. The emotional cycle of markets is painfully predictable. On the way up, people feel good, then great, then euphoric. Prices go up because greed makes people pile in. Then something goes wrong. Prices start falling. People feel worried, then scared, then panicked. Denial turns to desperation, and finally, at the bottom, total capitulation. That's the moment when people give up entirely, when the headlines are most terrible, when the last person finally sells. And that's exactly the moment the market quietly starts turning. You can't time this perfectly. Nobody can. But you can recognize the conditions, and that's enough. Now here's what's happening in 2026, and I want you to pay close attention, because the data is real, and it's specific. The S&P 500 started 2026 at nearly 7,000 points. It hit an intraday high of 7,002 in January, and then it started pulling back. Why? A combination of things that should sound very familiar by now. The US and Iran went to war earlier this year. The conflict effectively shut down the Strait of Hormuz, a waterway through which roughly 20 million barrels of oil pass every single day. That's about 20% of the entire world's crude oil supply, gone from the market almost overnight. Oil prices surged past $112 per barrel. Gasoline at the pump crossed $4 per gallon for the first time since 2022. Every time in history that gas prices crossed that $4 threshold, a bear market followed. Goldman Sachs issued a formal warning in March to 2026. Their base case scenario has the S&P 500 ending the year at 7,600, which would be new all-time highs. But their bear case has the index dropping to 5,400. That's a 22% drop from the January peak, which is the technical definition of a bear market. The range between those two scenarios, 2,200S and P points, is the widest outcome spread Goldman has published since 2020. Moody's artificial intelligence-driven recession model currently puts the probability of a US recession at 49%. When that model has crossed the 50% threshold in the past, back-tested over 80 years of data, a recession followed every single time. And that 49% reading was from before the oil shock hit. Prediction markets are currently pricing in a 50-50 chance of a formal US recession by year-end. The VIX, which measures fear in the market, has been hovering around 27. Its long-term average is around 20. When fear rises, historically, opportunity does too. And look at the Buffett indicator, the ratio of total US stock market value to GDP. It's currently sitting at 219%, an all-time high. Warren Buffett himself said that when this indicator approaches 200%, investors are playing with fire. The Shiller-Cape ratio, which measures how expensive stocks are relative to their long-term earnings, is at its second highest level ever recorded. But here's what makes 2026 feel so much like those previous setups. Oil shock. Check. That's exactly what triggered the 1973 to 1974 crash. Geopolitical instability. Check. An overvalued market coming into the crisis. Check. That's what happened in 1929. Rising recession probability. Check. That's 2008. And a market that has already pulled back but hasn't yet confirmed a full bear market. Check. The S&P 500 is currently about 6 to 7% below its January high. That's not a crash. But history shows that when the conditions align like this, the market often goes further than people expect before it turns. And when it turns, it moves fast. The 2020 COVID crash lost 34% in just 23 days, then gained back everything and hit new highs within 5 months. The 2009 bottom was followed by a 68% gain in 12 months. These recovery moves don't wait for you to get comfortable. They happen fast, and the people who are positioned before they happen are the ones who benefit. This is not to say a crash is certain. Goldman's base case is still bullish. Earnings estimates are still calling for 17% growth in 2026. The economy could absorb the oil shock if the Iran conflict resolves quickly. There is a real scenario where none of this becomes a full bear market. But here's the truth. You do not need a full crash to build wealth with this pattern. You just need to understand where we are in the cycle, be prepared, and act when the moment comes, whether that's now in 6 months or after a further decline. So let's put this together. In 1932, people who bought when the Dow was at 41 watched it multiply many times over in the following decade. In 1974, people who bought when the Dow was at 577 watched it climb to over 10,000 by the late 1990s. In 2009, people who bought the S&P 500 at 676 watched it climb to over 5,000 by 2024. The setup in each case: massive fear, external shock, prices disconnected from underlying value, news saying this time is different, and most people on the sidelines. The result in each case: the people who bought when it was uncomfortable made the kind of money that changes families forever. And here's what you should actually do with this information, practically, right now. First, assess where you stand. If you have money sitting in cash, in a savings account earning 4%, that feels safe. But you are losing purchasing power to inflation every single month. The question isn't whether holding cash is risky. The question is whether it's the right risk relative to your other options. Second, if you decide to invest, don't try to pick the bottom. Nobody can do that consistently. Use a strategy called dollar cost averaging. Take whatever amount you plan to invest and split it into 5 equal chunks. Invest 1 chunk now, then 1 more in 4 weeks. Then again, keep doing that over 5 months. This way, if the market drops more, your later purchases get better prices. If it goes up, you still participated. Third, focus on broad index funds, not individual stocks. The S&P 500 index has returned an average of about 10% per year over the long run, including every crash, every recession, and every crisis in its history. You're not betting on one company, you're betting on the economy itself. Fourth, do not look at your account every day. Seriously, the people who panic sold at the bottom of the 2009 crash, who turned paper losses into real ones, did so because they were watching their accounts go down and their brain couldn't take it. Set your allocation, set your schedule. Walk away. Fifth, invest money you won't need for at least 5 years. If you're going to need this money for rent, for a car, for anything in the next 2 years, it should not be in the stock market right now. This only works with long-term money. One more thing before I wrap this up. The S&P 500 has never, in its entire history, had a 20-year period where it produced a negative return. Not through the Great Depression, not through World War II, not through the 1970s stagflation, not through the 2008 financial crisis. If you hold long enough, the math works in your favour. The problem is that most people can't hold when things get bad, and that's exactly why most people don't build serious wealth. The people who do understand cycles. They prepare in advance, they have a plan, and they execute it even when their gut is saying stop. 10 years from now, people will look back at this period, at the oil shock, at the geopolitical instability, at the valuation reset, the same way they look back at 2009 and say, that was the time to be buying, not selling, not waiting.